Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the 7th episode of our InvesTips from the CIO's Desk series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and the host for this series. So let's say that you've paid off your bad, high-cost debt and put together your emergency fund. You've prioritised your spending so that you're able to enjoy yourself and still start to save on a regular basis. Now for the difficult step, investing. For so many people, this is actually the hardest step along the financial journey. It is a step into the unknown. Newspapers, news programs, YouTubers all highlight the bad things that are happening in the world and the risks that we face today. Yet inside, we know that we really need to figure it out, but we don't know how and when to start investing. So before we think about the how, let's just think about the difference between saving and investing and the role it plays in our lives. So both are good things. We talked about the emergency fund, which is effectively saving for a rainy day. You hope you'll never have to touch it, but you also know that at some point something will probably happen that you will need temporary financial support. However, saving should not stop there. You'll also want to save for expenses that you anticipate. So these could be a holiday, a car, or a phone. It doesn't matter what it is, but these things can really improve the quality of your life. And as we discussed previously, as long as you are mindful about what spending is important to you, then there should be guilt-free spends. But there's still a nagging sense that you should be doing more to prepare for the longer term. And indeed, this is the best way to think about the trade-off between saving and investing. Increased savings give you more security in terms of being able to maintain your lifestyle in the short term, say for the next 6 to 12 months. But by investing, you're taking care of your longer term financial security. And the reason for the difference relates to what we've discussed in the last episode, risk and return. When you place money in the bank, this is not subject to the vagaries of what happens in the economy or in the financial markets, at least not in the short term. However, once you start investing, suddenly what's happening in the economy, what's happening to inflation or interest rates, and obviously the political and geopolitical sphere can have a significant impact on your emotions by changing the value of your assets. This is naturally scary and often leads people who are risk averse to delay the starting of the process. On the other hand, deposits are actually very risky over the long term. We've seen extended periods in recent times when interest rates are substantially below the level of inflation. This is especially the case for low or zero interest rate current accounts, for instance, but has also been true for time deposits. Therefore, savings have lost purchasing power, which basically means the prices of the things you want to buy go up more than the value of your savings. Investing, meanwhile, is like giving your money a superpower. Over the long run, it helps to grow in value even after taking into account the impact of inflation. Now, we all have an inherent bias to focus on near-term security, which is why so many people never make the first step, or at least wait way too long before they start investing. But remember that time is your most valuable asset, especially when it comes to investing. Because of compounding, the benefits of starting early are difficult to overestimate. Therefore, while there is a trade-off between saving and investing, if you have an emergency fund and you are already saving for some one-off expenses, it's probably the time you start your investment journey. If you feel uncomfortable, then that's normal because it's new to you. However, feel free to start slowly and small with investments into something like a diversified fund or exchange traded fund, which with a relatively low level of risk, i.e. skewed more to bonds than equities. You can always tweak your approach once you get more comfortable. The important thing is to start and learning about investing, and the best way to learn is to do. That's all we're going to cover today. In the next episode, we'll discuss the differences between active and passive investing as you move along your investment journey. A difference, for instance, between a fund and an ETF. Until then, thanks so much, and I look forward to catching up with you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.